Good evening, everybody, and welcome to the next edition of On the Move. I'm one of your hosts, Rich Checkan of Asset Strategies International, and I'm joined by my co-host, Adrian Day of Adrian Day Asset Management, who needs no introduction, but I'm going to do it anyway. Adrian is a good friend. I've known him for about 30 years now. He's born in London, graduate of the London School of Economics. He's written several books on our favorite topic of resource investing and so forth. He is the brains and the man behind the Europac Gold Fund, which I understand is doing pretty darn well. He's the founder, owner, principal of his eponymous asset management firm, Adrian Day Asset Management, where he offers individual accounts to investors focusing on international and natural resource stocks. And he's an amazing talent. I got to tell you, I've heard him speak, and I always love to hear it. So, Adrian, thanks for taking us off here tonight, and welcome.
Well, thank you, Rich. You're too kind with that introduction. Again, I need to introduce the co-host, Rich Checkan. As he said, I've known him for probably 30 years now. He's the president and COO of Asset Strategies International, and his uncle is the CEO, right? And I've known his uncle even before I knew Rich. But Asset Strategies International, is a gold firm, bullion and coins, including the Perth Mint. I'm sure you'll tell us about that a little bit later. So anyway, Asset Strategies is a firm I recommend very highly. Well, our guest tonight is, I'm really looking forward to this. John Doody is someone that I've known for many years. Gosh, I don't really know John how long, but certainly a couple of decades, if not more.
Well, we can use 30. Everybody else is 30.
Time flies when you're having fun. But, John has a background in economics. He had a BA from Columbia, an MBA from Boston, and then he did his PhD in economics also at Boston, and was an economics professor for almost 2 decades. So we're going to ask him about the economy later. But as I think everybody knows and why you're here tonight, he started in the mid-90s. He started his own newsletter, Gold Stock Analyst, to focus on, he had a top 10 and to focus on top gold stocks. But honestly, John, that looked to me to be such a huge amount of work. People call it the value line of gold stocks. So a lot of work went into that. As people know, he retired a few years ago, but due to overwhelming demand from his fan base, he came out of retirement to start a new newsletter, the Doody five favorite, for people who don't know, 5 Fav Gold. So we'll be talking about that a little bit later, but welcome, John.
Well, thank you very much, Adrian. It's a pleasure to be with you. And even though it's telephonically or whatever it is, not the same as in person, but you always have great restaurant recommendations. So I don't know if I could get it from you tonight, but
yeah, we have been to some good restaurants.
That is a fact.
So, because obviously gold broke through 4,000 last night and it's up again today, I hope you don't mind. We were going to start with, lay the foundations of the economy and everything else, but let's just look at that, John. Obviously gold's been going up for 3 years now, but the last couple of months is really shot well above trend, and as I say, we're over 4,000. What do you see as the main factors that are driving it, particularly recently, this recent drive, and will they continue?
well, I've written that I see the main factor is Trump. The chaos that created around his presidency and all the uncertainty with they're going to get control of the Fed, or the tariffs, now the lack of information because they're not funding the information gathering sources. I think that people are just hesitant to rely on the typical powers that be, and they're buying some insurance with gold. It stood the test of time for thousands of years, and And it's interesting that while gold is up, the dollar index has not gone down much. That the dollar index is down around 9% this year, and but gold is up over 40%. So usually they're linked. That one goes like a seesaw, one goes up, the other goes down. But and that's the way it was the first Trump presidency when the dollar index was down around 10% and gold was up about 50%. But it's much more dramatic this time.
Yeah. Well, we've already lost half our audience, John, but
Yeah, I'm sorry for that, but I speak the truth.
but look, may I just gold has been going up obviously for 3 years now. And 3 years ago, that was a long time before people even thought Trump would come back. So I don't think this gold bull market can all be Trump. What else is going on?
Well, we could look at each of the single issues that have come to forward. The tariffs and what's going to be the impact on the U.S. economy. We still don't know yet because the tariffs are kind of getting wiggled and jiggled and coming into fore. And what about inflation? We don't know what the real inflation is going to be because they're not funding the data gathering. And so I think people are just looking at alternative places of refuge now, and maybe it'll all settle out in a couple of years, but maybe it won't. I don't know. I mean, I think I've been 100% in gold for years, so I'm just talking my book. But that's paid me very well. Remember, it was my grandfather gave me a $20 gold piece in 1972 when Nixon went off the gold standard, and Gramps said, hold on to this, John. It'll be worth a lot one day. Well, Gramps isn't around anymore, but that $20, $35 worth of gold is now worth $4,000. So it's really a progression of value increase for gold.
Yeah.
If I could add, I tend to agree with John that the chaos right now that's going on absolutely has contributed to I guess, the velocity of gold moving higher. There's no question about that. I mean, we can see it when you turn around and every week gold's going up $100 an ounce. That's not normal in any circumstance. I do go back. I mean, I know you've hit on this point, John, in the past where, 1971, that's when kind of the wheels fell off, and you could see gold rise from then on. Now there are bouts where it takes off and it pulls back a bit and so forth. But I really think it all comes down to, the lack of fiscal responsibility. When the only way to avoid basically defaulting on your currency is to do these little paper cuts of, fiscal, or monetary expansion. Everything of value is going to go up in price over time.
Yeah, and the politicians, their single most important role for themselves is to get reelected.
Amen.
And there's no restraint on them, or they may be on some, but not enough restraint. And it must be so great to be an elected representative in Washington that you'll sell your soul to get reelected, and that's what they're doing. So gold has had an increase over 9% a year from 1971, and I don't know of any investment that's had that kind of compounded rate of return, and I don't see any end.
Right. No, absolutely.
That's okay without interest and dividends. I'd take that anyway.
Yes.
Yeah. So, John, to what extent, there's been a lot of talk about, the dollar losing its status as a reserve currency and the Mar-a-Lago Accords and the resetting of the global monetary system. To what extent do you think that is playing into gold moving up?
Well, some. I mean, it's an issue that I suppose some people think about. But it took 150 years for the pound to lose its reserves currency, and it took two world wars to do that. And now we're 75 years. Bretton Woods was really the turning point where the dollar came into fore as a reserve currency, and we're 75 years after Bretton Woods, and if it's a 150-year cycle for a reserve currency, we've still got half of that cycle to go. So, but there's no question that alternatives are being sought, and some of it forced onto them by by U.S. policies. Is forcing Russia and China and the BRICS to come up with another way to trade between themselves because they don't want to use the dollar. But the dollar is still overwhelmingly the highest percentage of currency used in world trade. So it may be a declining percentage in reserve currencies, but on a trade basis, it's overwhelmingly, over 80% on trade basis.
Yeah.
Right. Right.
I tend to agree with that. I think some of the impact of what you're suggesting, Adrian, and we're seeing with the central bank purchases, right? So this past year we've seen gold as a tier one asset surpass the euro, which was number two, and then U.S. Treasuries as number one in terms of currency reserves. So I think that has a lot to do with what we've seen the past few years in the gold price moving. But I do think the chaos is really putting a little afterburner on the increases right now, for sure.
Yeah. Let me switch the subject, if I may. We were talking about gold at 4,000. The gold stock in, the GDX is up 80% this year. So the question, but a lot of new people might be asking is, has it gone too far too fast? Are we overdue for a pullback?
Well, the history of gold investing is there have been pullbacks, but I don't see anything changing in the near term that's going to stop driving it higher. That I don't know what the source of a pullback would be. This is a macabre thought, but I almost think that if something happened to Trump, he died of old age or something like that, that might be bad for gold. But absent that, I think it's going to continue higher.
Okay. And
so if we do see a pullback, would that be something to be embraced or as a short-term phenomenon to get some a little cheaper, or is that something to be feared, you think?
Well, it depends on your position, I guess. I'm all in, so I wouldn't embrace it because it would hurt. But I think a lot of people are not all in yet. It's you don't see any articles in the Journal or the New York Times or whatever saying gold at a top. I mean, they're now paying attention to gold, but they don't know really how to think about it. And basically these people haven't been around for as long as us guys, and they don't understand the impotence behind gold. But I don't see anything coming in the soon, because I don't think that the BRICS and the Chinese Russian alliance is going to add up to much in the short term. In long term, sure, but long term in the gold history is going to be after I'm gone, and unfortunately, so nothing happens overnight, and even in a couple of years, it's a long-term trend.
Even if you do pass, John, I'm betting on you coming back and starting another newsletter, though.
Well, somebody might take my place, maybe. I don't have any kids.
I agree. There's absolutely no indication at the moment of, a top. You and I, we'll leave Rich out because he's the newbie, but we remember the top of 1980 and 1996 and so on. And there are certain indicators. Of course, stocks get expensive, but in the gold market, I think it's more, and you may disagree with this, I think it's a lot more than just fundamental analysis on the value of the gold stocks. You get these anecdotal signs of a top. When you go to when you go and get a coffee, the barista wants to tell you about his latest gold stock tip. And when you go to a dinner party, all people want to talk about is gold and what they're buying. And we saw that in 2006 with housing, of course. We saw it in 2000 with dot-coms. We're not seeing that or anything close to it right now.
Well, I agree. I'm not getting invited to dinner parties anymore. And maybe I stopped getting invited because nobody wanted to hear about gold anymore. But now the invitations have not been streaming in. But there are indications that of a top. I mean, we learned this from the past tops. Volcker's jacking up interest rates in 1980 to stop inflation. That clearly, in retrospect, was a big sign of a top. but we're not getting any interest rate jackups now. We're getting pressure to lower them. And that's going to keep the gold price rising, in my opinion.
Yeah. And in 2011-12, of course, which was the last big top, you had so many mining companies do crazy M&A deals, overpaying for marginal assets. And even though M&A has picked up a lot, I'd like to, let me ask you the question, and since you're the guest, M&A's picked up an awful lot, but I haven't really seen any crazy deals. There's deals where I think maybe they overpaid or something, but I haven't seen the sort of crazy deals that we saw in 2011. Do you agree with that?
I do, and among the major miners, gold miners, there haven't been really much for deals at all. They've been more about divestment rather than Barrick getting rid of, it's half of the Nova Gold mine and selling Hemlo and Newmont getting rid of half a dozen mines. Probably they wish they'd kept now because they're really, really some great mines. And these divestments, particularly the Newmont ones, spawned some great intermediate companies that have gone doubled in price because now they're freed of I don't mean to say that Newmont was overbearing, but on their own, they've come under their own as great investments on their own, particularly in this gold price environment. Now, if gold hadn't gone anywhere, maybe they'd be wouldn't have done much. But it's almost like Barrick and Newmont got rid of these mines at the exact wrong time.
Right. But it's also streamlining their businesses. I understand that.
Yeah, no, that's okay. I don't criticize them for that, but they've created opportunity among the intermediates that we have one intermediate that's been a participant in part of that's tripled in the last year. So.
Yeah.
If I could, there's one question Tom asked, and it's kind of on the subject. And I think I know the answer because we're talking about no indications of a top at this point. But Tom asked, should we continue to hold our gold stocks, especially your Fave 5 stocks?
Absolutely.
Yeah. Well, look, let's get into that if we may. John, why don't you, you'll have plenty of opportunity to pitch your newsletter later, but why don't we get into what is your analysis for looking at gold stocks? How do you analyze gold stocks? What are the most important criteria? And why 5? Is 5 too small a number?
Okay. It's a number that's working. I mean, stocks are up 150% this year. So, but the analysis is based upon the understanding that all miners produce the same thing, gold ounces. It's not Coke versus Pepsi or Sprite or anything like that. It's gold ounces versus gold ounces. And what are you paying for those ounces? And the way that you look at what you're paying is either what's the market cap per ounce of reserves, what's the market cap per ounce of production, and what's the operating cash flow from these mines. And it's the cash flow operating multiple is the key determinant in which mining companies to invest in. And over time, the operating cash flow average in the industry has run from about 4 to 12, and right now it's about 7.5. And which means, but the average bin is around 6. So the average operating cash flow multiple is above average, but it's got a lot way to go to its prior peak, which was in the 2009. And so, but I want companies that are trading below the average. And so we have companies that are trading at 2 times operating cash flow, up to 5.5 times operating cash flow. These are really bargain stocks. And either it's not recognized by the Mr. Market that they're a bargain yet. That'll come to the fore, I think, over time. But you're investing in gold stocks that don't have a lot of downside because they're not selling at peak prices now. Some gold stocks are selling at peak prices, and some are worth it. Like Agnico is priced at around 11 times operating cash flow. It's a terrific company, and I would still be a buyer of here at Agnico at this price, but it's recognizing that you're really just going to participate in the gold price increase. It's not going to get any jolt from some activity that like an acquisition or something, or a new mine that comes on. It's not going to get a jolt factor. I look for companies that have a jolt factor in addition to be undervalued. A way to get out of this undervalued box that they're in.
Well, when you say, you know, all ounces are the same, I mean, obviously you look at political risk. I mean, an ounce in Mali is not quite the same as an ounce in Nevada.
No, I don't cover stocks in Mali.
Very sensible. But generally, how do you look at political risk? I mean,
I try to avoid it. You know, I'm not willing to take any political risk because a five stock portfolio is not big enough to handle political risk. If you're the GDX and you got 53 stocks in it, you can have a little political risk, and you're going to have a little,
right,
or a lot
right.
maybe. But a small universe that you're recommending is you just can't take any risk.
And John, for your sorry, Rich, you can jump in when you want.
No, that's okay.
For your Fab Five, are you looking? I'll use the word mechanically, if you don't mind. Are you looking purely mechanically using the criteria that you just outlined, or do you also look at quality of management and things like that?
Oh yeah, no, I look at that, but the operating cash flow multiple is a place to start. I want to start with undervalued companies already. One of the Fave Five is run by a company bought mines that Newmont divested, and it's run by a guy that gave us our last 10 bagger when we were at Gold Stock Analyst. He ran Kirkland Lake Gold, and it became a 10 bagger and actually a 15 bagger because Agnico took them over. The mine that they had was a detour mine, and if you'd held the stock that came from the takeover of Agnico, Agnico's takeover of Kirkland Lake, you were up 15 times on your investment. We recommended that stock around 7, and now they got 8/10 of a share of Agnico, and now that stock 8/10 of the current Agnico price is around 140. So it was a huge increase, and it's the same guy that ran that company now is running our Fave Five, and we made it Fave Five because of their purchase of mines from Newmont. A nice 4 mine package, and one of them is going to come back into production soon, and 3 are already producing around 300,000 ounces a year. I'm not interested in startup companies. I'm interested in companies that are already existing and operating. Maybe they've run into a problem like a mining disaster or something, or permit problem, but you know, there's a basis to the valuation. They're not a single mine operation.
Right. Okay, is that another thing you look at? Is that a big criterion?
Yeah, I want companies that have what I call the jolt factor, something that can happen that we can reasonably expect to happen and jolt them to a higher price.
No, but do you prefer companies that are multi-asset?
No, one of the Fave Five is not a multi-asset. It's a single asset company, but its jolt factor comes from the value that I think it gives the shareholders, and it's going to be taken over,
Right.
in the next few months, in my opinion.
If I could, Adrian, divert a little bit. I'm assuming most of your focus is on gold. Is it all on gold? Do you have some silver or interest in platinum, palladium?
Um, the short answer is no. It's all gold, but I think silver is no question used to be a monetary asset, and it still is for some. And of course, it's just poor man's gold, and it's done very well lately. It languished for a long time, but it's done very well. And this year, as gold has gone up, silver has sort of dragged it along. I I I think silver trades as a derivative of gold. If gold does nothing, I don't think silver is going to do anything. But when gold gets going, silver can be multiples of gold, and it's worthwhile to have some silver in your asset bag.
Gotcha.
Yeah. So along those lines, your criteria seems to suggest that you're looking at miners. So do you also look at development companies? Do you look at royalties?
Well, no royalties. I love the royalty model, and it's great. It's a stable model, but there's no jolt factor there. There's not the only jolt I see is maybe Franco can get Cobre back in production, but it's not that might give a jolt to Franco's price. But I don't they're so well managed with a huge portfolio of mines that all of them, the Royal Gold, the Wheaton, and the Franco, there's not much of a jolt potential. There's a good potential to own them and expect them to do better than gold over a long time. But I'm not looking for a 10-year, 15 years horizon to invest. Despite my grandfather gave me that coin so many years ago. But that's not my horizon now. I'm looking for shorter term returns, like 1 to 2 years. And so I don't see that in the royalty companies. And even though the three that I mentioned, I think are all great companies. So what was the other part of the question?
Well, developers and explorers.
Developers. Now, unless they've got a feasibility study and they're raising the money or they've got the money to develop, I'm not really going to follow them. I'm not a geologist. I don't pretend to be one. I don't know much about rocks beyond rocks for jocks I took in college, so it's best to. I want to invest in companies that if they're not yet in production, they've got a feasibility study by an independent company, mining company, that mining engineering company that says that yes, this mine can make money and if they put the money into to build it. And we have one company in the Phase 5 that's at that stage. It's going to produce over 1 million ounces a year when it gets funded, but it's still looking for its funding.
Well, from what you've just said, and the nice words you said about royalties, but they're not in your Fab 5. Your Fab 5 is really offering a very specific, specialized service. And so maybe that comes back to my question about why 5. Are you suggesting that for a typical gold investor, 5 stocks is enough?
Well, it depends on the typical gold investor. I think it's enough if you want to have an exposure to stocks in the industry that have an upside potential, significant upside potential in the next year or two. Most gold investors are going to hold more than 5 stocks because they're going to have a favorite or a few favorites or whatever. And if there's a thought that the generalist investor used to say, well, I need a gold stock in my portfolio, to balance off my General Electric or my IBM or whatever. Well, that was an idiotic thing to think about because you can't, unless your one stock is going to be Agnico or it's going to be Franco, you're exposing yourself to too much risk. Mother Nature disappoints too often in the gold business, so one stock carries a lot of risk to it. And just as many stocks carries a lot of risk to it because the GDX until this year had been a lousy performer. Our audited period of time that covered 23 years, we outperformed the GDX by 5 times. GDX was up 3-something percent, 3 point something, whereas the top 10 was up 19.3%. So you need a balance between one stock and 50 stocks, and five is a nice ring to it. I can handle that. I can handle the it all has to go through this brain, maybe that's the processing error here, but
Seems to be working fine to me, John.
Yeah.
Well, it's
interesting what you say because our friend Rick Rule, he looks at clients' portfolios, and the one I was just talking to him on Saturday, actually, the one consistent theme in those portfolios is most investors have far too many stocks.
They hear a story and they want some.
Yeah, but they never sell. So that gets me to my next question, selling.
You beat me to the punch.
What is your sell discipline? How do you decide when to sell? Does it depend on whether you have something else to replace it or?
Yeah, well, when to sell is we give target prices in our letter. So, those change over time because gold price changes over time. And we've had target prices lowered too because of things. But in the Phase 5, we've had one sell in our existence a year and a half now. And that was because they had a change of management. And the management wasn't producing the ounces that the investor wanted. And I don't know if it was mutual or not, but the mine stopped production, in order to do more development. You have to, you just don't go out and scratch the ground and find dirt to put in the mill. You have to have enough dirt to put in the mill to make the mill operate efficiently. So they couldn't find enough ore, and the management left. The major investor left, and I said, "Boy, that's a reason to get out." And so that stock was six cents when I said sell. We'd recommended at 30. It was 6 cents when I said sell, and now it's at 3 cents. So we salvaged some of the money, but it was and this was a mine that had feasibility studies showed it should be profitable at $2,000 gold. So things don't always work out the way that geologists think. When you drill the holes in the ground, there's a spacing. You're going to be 10 yards away or 10 feet away or whatever the spacing is going to be. You're not salvaging. The only way you know exactly what's in the hole in the ground is if you mine it all. And that happens. Then you know what you had, but then it's gone.
Then it's too late.
John,
One sell in 18 months. Obviously, you don't have huge turnover. Do you see investors? This is a leading question. Do you think one of the mistakes investors make is just trading too much?
Yeah, or not having enough information. If you buy the stock, you have a continuing flow of information on it. And I think some people or some investors, some newsletter guys think, well, they're going to get annual reports and quarterly reports on their own. I don't have to keep telling them about them, but
Yeah.
I keep up. I know you do this. You update people on the stocks, and I think that's critical because if you're relying on us for investment information, we should be able to tell them to sell or to buy more or something like that. But the information flow is critical. If you're not going to have good information, because you heard a story. I'll give you a good example. When I started, I would be at a cocktail party and somebody would ask me, John, what's a good gold stock? And at the time, I loved Bema Gold, which I'd been to their mine in Chile, and it was it became a great stock, but I lost interest when they moved into West Africa with their development. But in any case, somebody once asked me what a stock, recommend a stock, and I said, well, buy Bema Gold. It's about $2 now. And I saw the same person at a cocktail party a year and a half later or something like that. And they said, John, why didn't you sell? You told me to buy Beamer. It went to 6. Why didn't you tell me to sell? Yeah, I said, I didn't know you bought it. And you didn't have you didn't subscribe to the newsletter. So,
Right.
if you're going to buy somebody's recommendation, you better make sure that you have a continuing flow of information on that.
No, absolutely. Absolutely. And that's why, frankly, it will be, I know you're not going to do it, but frankly, it will be a total disservice to people for you to name your Fab Five on this program. And people would buy them thinking, oh, well, I don't need his newsletter now. I know his top 5. I've always said this, you've got to, wherever you got the recommendation from, you've got to follow that person to see. But the question I was asking, John, is you've had one sell out of 5 in a year and a half. Would you say your intention with these stocks is sort of to hold until the final resolution, whatever that is? A takeout over or something?
As long as the continued upside. I mean, we continually raise target prices, as we've done because gold has gone up. We started the newsletter when gold had just passed through $2,000 an ounce, and now that gold is $4,000 an ounce, the next issue I'm going to run through all 5 and recalibrate all the target prices because that's merited. But also the one thing that people should not rely on 100% is what's the current price. It's what the average price that gold is going to be for the year. Like right now, while the current price may be $4,000, the average price for gold for this year is $3,300. That's what miners make the decisions on, and that's a good increase from last year's average price, but don't get carried away by the current price. Think about the average price too.
I know I shouldn't say the name because he may have changed his approach, but a very, very, very well-known gold investor who would, everyone on this call would know would know the name. But he said to me many, many years ago that he only ever had 5 gold stocks. That's all he ever had. And if he found a new one he wanted to buy, he examined his 5 portfolio to say which one, however much I like it, which one do I need to sell to replace with the new one? Do you ever look at something like that?
Well, I try to stay with 5. I know with top 10 we had an 11th every now and then, but I think discipline is important in this business, and at this moment I don't have any candidates that I would add. There was one maybe a year ago that I would have added, and I was holding it back, and it's now tripled. I should have added it, but so it's not. It's gone up more than it should have, and it's still got the same permit issue that scared me back then. So.
Okay.
So
But
John,
if you,
is it safe to say that, you know, you have targets for all your 5, and
Absolutely.
but you're still always looking for something else with a bigger jolt factor potentially that could bump one of those 5 out and be replaced. Am I right?
It's possible, there's a new girl at the dance, who knows, that, you don't ever say never, never say never, right?
Yeah.
right, right.
But, I'm working the same group of stocks. It's unusual that another company comes along. One company was spawned by the mines that Newmont sold, and it turns out they're run by the guy that gave us our 15 bagger.
Right.
So that was a perfect, and that guy grew up in the area of those Newmont mines, so he was a perfect addition. But it happened. I guess I maybe had an issue or two when I sold the one stock that I didn't have a fifth, and when this stock came with the Newmont mines, jumped right into it, and it's more than doubled since then. So.
Well, it's interesting. I mean, I think anyone in the business knows which stock you're talking about, but not a secret. But it was interesting that when he bought that mine package from Newmont, the stock actually did well immediately, and of course it's done well since. And we've seen the same thing. We saw the same thing with Orla when they bought Musselwhite. The stock
Yeah.
went up. And it strikes me that that's a little bit of a change from what you saw, let's say, 5 and 6 years ago, when companies would buy the cast-offs of Newmont and Barrick and Goldcorp. They didn't actually respond well. The big question was, well, if Newmont doesn't want it, what makes me think that Joe Schmo can run it? I think now the narrative has changed to, well, Newmont or Barrick doesn't want it because they say it's too small, but this guy is more nimble and is going to be able to make an improvement. The narrative seems to have changed. So these cast-offs, or whatever you want to call them, have actually proven to be a pretty good way of investing.
Absolutely. The jury's still out on some, and a couple of them went to private companies, so we don't have any way to follow them.
Yeah.
The ones that have been public, have done well.
Yeah. Yeah.
So,
Is
so
everyone
Adrian,
good? Sorry?
I was going to say, Adrian, this has come up before. You know, we've had discussions with other asset managers, and there's this, thought that the general diverse holdings is, not really helpful to a client, whereas staying very focused on the best of the best is a much better approach. It seems like that's the tact you've taken. And can you talk to that and how that might have, it might be the problem long term with gold stock mutual funds, for instance?
Yeah, okay. I think it was Buffett that said diversification is for dummies, and who don't really know what they're doing.
Yeah, he said it's
If
an
you know what you're
excuse for
doing,
ignorance.
you can zero in on the best of the best. And if you're running a mutual fund, you've got to deal, and Adrian knows this better than anyone, that you've got to deal with the prudent man rule, that the SEC wants to at least see 20 or 30 stocks in your portfolio, thinking that that's what a prudent man would own. But a prudent man wouldn't necessarily want that many stocks. but you've got regulations to adhere to, and you know that's what you're stuck with. You do the best you can, and you know, now with gold going up, almost the rising tide is floating a lot of boats that should have sunk. But we'll see who's swimming naked when the tide goes out, if it ever goes out. Um, but um, but I think, you know, it's the same issue that we come back. People have too many stocks in their portfolio, and when I used to do these gold shows, I mean, I had a guy come up with a one time with a printout of like 3 pages long. Must have been 100 stocks on the list. I said, how can you either follow these and you know what are you doing? You have to make a decision, and so. I agree 100%. I also think that everybody should have bullion as a basis in their portfolio. You know, I choose bullion coins because I think they're more easily sold if ever necessary than say bullion bars. But you know, that should be the basis for everybody's portfolio, and that's the ultimate fallback. If it all goes to hell and the stock markets collapse and we can't get our shares sold or whatever, you got bullion stored somewhere that's what you got.
Hey,
That's
Adrian,
music to Rich's ears.
I was just gonna say, and I don't want to cut any of this conversation off, but there's actually a question here from Raj that I saw earlier that I think kind of dovetails nicely. And I think we ought to go around the horn, and we may hear some different responses, to be honest with you. But he says, what would be an ideal distribution to go all in for gold in a portfolio? Physical gold from ASI and gold stocks. So basically, you know, the gold spectrum, whether it be stocks, physical, etc. What do you think, Adrian? What do you think, John, are your perfect mix?
Who do you want to start with?
Either, whoever's ready. Maybe John, he's our guest.
Well, I'll go first. You know, as I said, I'm all in on gold. I don't own anything else, and I have some bullion in a safe, and I have some ETFs, the gold ETFs, not the gold stock ETFs, and I have shares, and you know, is it maybe 10% bullion in the safe, and maybe 10% more in the shares, and 80%, 10% more in the ETF, gold ETFs, with the share ETFs, and also, and then the balance in stocks themselves.
Gotcha. Adrian?
Yeah, no, I broadly agree with that. So we're just looking at the gold portfolio, and by gold, I mean gold and silver. I'm not going to break them down at this point, but I would say 20% or even 25% in physical or physical ETFs is the right balance. And again, I would say half of that is your long-term permanent insurance, and maybe half of that is a more long-term investment, but still all in physical. And then the rest, 75, 80% in equities. I would definitely have some of the top royalty companies as a foundation for a portfolio. And John's already mentioned them, Franco, Wheaton, Royal. I would definitely have some of the top large mining companies. But frankly, in my view, there aren't too many really large miners that are really good companies. Agnico is the gold standard, but there's a lot of gold miners that, you know, might be good for this point in the cycle, but I'm not sure I want to own them, you know, throughout the entire cycle. And then I would look for smaller miners with growth, like the ones John's mostly recommending, and some of the ones we've mentioned. But and then I also would have a few of the exploration companies. But in everything I do, I would be looking for the best. I'd be looking for the best exploration, and by best, you know, we can talk about what that means. But with an exploration company, to me, best is management above all else. But looking at the best of the best in each of those categories.
Gotcha.
Yeah.
And from my standpoint, I'm a bullion guy. I leave the equities up to experts that do that for us. And we have one in particular. I think you might know him, Adrian. But you know, you do that very well, and I trust your expertise and your results. When my only difference is I don't mix gold and stocks together, gold and gold miners, etc. I look at the gold miners as part of my equities allocation, and I leave that in the hands of experts that know that field much better than I do. When I look to the bullion, this might surprise some people, but I'm not all in. I'm a firm believer in gold and what it does for your portfolio, but I believe in 10% of net worth in bullion gold. Now that's net worth. That's not investable assets. It's a bigger number. But 10% of that number, you buy it, you hold it, you never ever get rid of it unless you have a financial crisis that you need to meet. You sell it immediately, meet the need, and then you try to backfill it as quickly as you can for that next crisis you hope you never have. In a bull market like this, I add additional funds to precious metals, bullion for profit. I like gold. I like silver even more for that purpose. And I'll add another 10 to 15% of investable assets, not net worth, into bullion for profit. And I do think we are just getting going in this bull market. I like you, see no indicators of a top, and I've got about 10 that I look at. Not one of them is firing right now. The storm clouds are not gathering.
Yeah. Well, you mentioned some in there for you kept emphasizing for profit and other ones you're not going to sell. And John's mentioned his target prices. And all of this really makes me think of one thing. But when you buy something, it's very, very important to know why you're buying it, what you're buying it for, and what is going to make you sell it.
Yes. Or where. You have to have an exit strategy or you're not an investor, you're a collector.
Yeah, yeah. And I find all too often, particularly with stocks, people will buy and then they change from being a value investor to a growth investor, or they change from being a growth investor. If a growth stock stops growing and goes down, they suddenly say, oh, well, it's good value now, I'm going to hold on to it. I think you've got to know what you're buying, why you're buying it, and know what's going to make you get out of it. On every stock I buy, I just do it on paper because I'm a paper person. But I mean, I make notes about what is going to make me change my mind. And it's a great discipline because, again, it's all too easy when something happens to have this ex post facto rationalization and say, oh, well, that was that. I'm still going to own it. And for me, again, change of management and a change in direction, a company that changes its fundamental, its fundamental mission statement, or fails to execute properly, that's going to be something I sell. I might revisit and buy back. But I found over the years that if companies change what they said they were going to do, you're better off, which means fundamentally the company has changed. You're better off selling and then revisiting rather than holding on. But
I'll add, if you have a really good asset manager, they'll ask you a bunch of questions, and if you answer them honestly, they'll tell you what you are, whether you're a growth investor or what have you.
Well, that's true too. That's true too. Rich, I see a lot of questions that you can see and we can't. Are there any?
I can see them. My big question is, do we want to get into individual stocks? There are a bunch of questions here about individual stocks. Should we get into those? I see the risk. I think Adrian voiced it earlier that, you're potentially telling people to buy something that they're not going to keep following up with, and they're not going to have any further.
I think we can, if there's some questions, we can answer them the way we want to.
Okay, sounds good. So I'll start firing them off if that's okay, in no particular order. First question was, why was 1996 significant, the Bre-X scandal?
There was no gold there.
There you go. All right. Do we need to add anything to that?
I was one of the first to say it was a fraud. Barron's picked it up and ran it. And the indications I got, I never went to the site. The analysts were tripping over themselves to give higher and higher estimates of what gold might be there. And I wrote an article that said Central Bank of Busang, which was the name of the area, and question mark. And then as I studied it further and further, I mean, they're talking 6 million ounces a year from this one site, which is all based upon salted gold, but the gold wasn't there, and the but it was a place you couldn't get to. You had to helicopter in. When I talked to some analysts who've been there, and it was an unusual site. Usually when you go to a gold mine, there's always some analyst who wants to stay and hang around the core shack and examine the core, the drill core that they pull out of the ground, and that's that guy's or gal's shtick is looking at the core, but there was no core for Busang, Briex, because they ground up 100% of the core. They ground it up and sent it off for assay. So that meant it was easy to salt because there was nothing to compare it to. And then the gold itself was river gold. It wasn't gold that had never been, meaning had been flopped around in the river and the edges knocked off or whatever. It wasn't gold that had been in the ground and would have sharp edges and from never having been disturbed. So those are the things that bother, and some other things. And the company called me up because Barron's ran that. The company called me up and said, "We're going to sue the hell out of you." And their loss of market cap, which was not entirely due to me, other people were being cynical too, but they were talking about $1 billion lawsuit. And so, I changed, I got incorporated right away.
Well, it's interesting, John. There were a lot of red flags. The other thing that to me, but people would ignore them because greed, especially in a hot market. Remember, 1996 was a hot market, right?
Yeah.
For gold stocks. And in a hot market, greed takes over, and people will only look at the upside and not look at the risk. But there were red flags. But the other thing I'd say, you just talked about, they were going to sue you for $1 billion. When the market cap of Briex became larger than the market cap of Freeport, which had a large operating mine in Indonesia, you knew something was wrong. Now, maybe Briex was fairly valued, but it should not have been valued more than the company that was actually producing gold at one of the largest gold mines in the world. So, yeah.
Okay. All right. Well, thank you. The next question. Does John have any new thoughts on Bellows Sun?
Well, that's a company that I followed with Gold Stock Analyst. It was at one point a GSA top 10. What happened was that it has a site in Brazil that has a feasibility study that means that it'll make money, and the thought is that it's held up by permit issues because of some intractable lawyer or senator or something there, and I still have some, but it's not worth much. But I wouldn't sell it because you're not going to get much for it. So, I'm not, and I'm not going to write it up as some kind of possible thing because it's, until the permit issue gets settled. They do have new people involved. In fact, the Juicer people got involved, and they're good people to have involved. So whether they can solve the political quagmire associated with it or not, I don't know. But they did spend money to buy shares.
Gotcha. Is there anything to add to that?
No.
Okay. All right. Next, would you add any silver miners in the future? I think you already answered that, but just want to make sure.
Is this again for me?
For anyone.
Add a silver miners?
Yeah. Would you add any silver miners?
No.
That's what I thought.
No.
Yeah.
Most silver is produced as a byproduct, and there's only a couple of pure silver miners, and
Yep.
one is Aya, AYA, and that in Morocco has a very interesting mine that they're producing. And if I really wanted exposure to silver, I'd buy Pan Am. the biggest, and they've got two huge projects that they haven't been able to. One is the Tahoe mine that they might be able to get started back up again. I think it was 20 million ounces a year. It's not in the stock price. And there's another one, Navidad site that they have that is not in the stock price either. But I'm not skillful enough to understand the smaller silver companies.
Gotcha. Adrian?
I generally agree. And John's main point is one I've harped on emphasized many times, and that is that most silver is byproduct silver, and something like 75%, in fact, of silver produced is byproduct silver. And so therefore, following from that, you have relatively few pure silver mines. So whether you're looking for a producer or an exploration company, your universe of potential stocks to buy as pure silver companies is a lot smaller than it is for gold. And as a result of that, most of them tend to be overvalued, in my view, because there's so few of them. And I agree completely with John. I mean, if you want silver, I would get your silver exposure through a company that's producing gold and silver, and is a company you like anyway. Pan American is a perfect case. I think this year, with the acquisition of Mag Silver, silver revenues are only going to be about 24 or 25% of the company. So it's still only a minority. But when silver goes, because they've got the name silver in their name, Pan American tends to move up. And in addition to that, as John said, they do have enormous leverage from Escobal and Navidad, but particularly Escobal, which will probably come back on at some point. And that's the fourth largest silver mine in the world. That'll be big.
Okay. All right. Another question, I guess, for both of you. Would the royalty companies be perfect for a retired investor to merely collect the dividends each quarter? Now, I know they're not going to be part of your Fab Five, but wouldn't they? The question is, would they be perfect for a retired investor?
Well, depends on your income needs, because they're all priced so high now that their yields are about 1%, and you might get a better income from a higher, higher dividend paying stock.
Gotcha. Anything to add to that?
Yeah, you've made the point I was going to say. I would say that royalty companies, I would put it this way, but royalty companies are the ideal vehicle for a retired person to get gold exposure. But forget about them as income stocks. You're not going to be able to live off it.
Gotcha. All right. So I think that's a resounding no.
No, I said they're ideal stocks for a retired person's gold exposure.
Gotcha.
But they're not dividend stocks.
Gotcha. Okay.
Yeah.
All right. Adrian has a question, not our Adrian, the other Adrian Cantwell. He would like to know, all other things being equal, in this cycle, do you think the major metals producers are likely to prefer to acquire a pure gold company or a gold company with a decent copper kicker?
Who do you want to go first?
Any thoughts?
Well, certainly Barrick, and I'll jump in. Certainly Barrick and Newmont are very big on copper. And I think they would prefer to have something with copper as well as with gold. But I don't think they really look at it that way. I don't think they look and say, well, we're not going to buy that great deposit because it's only gold. Let's look for something that has gold and copper. I don't think they look at it that way. But I think Newmont and Barrick in particular are definitely open to copper projects that have a lot of gold in them. Agnico, as you know, has some exposure to copper. St. Nicholas, is it St. Nicholas? What's the name of the mine? Yeah, in Mexico. And it's actually an interesting, because not only is it Mexico, which was doing badly at the time, it's copper, which was outside their bailiwick, but it's also a minority equity interest, which normally Agnico doesn't go ahead and buy minority interest in mines. So this sort of broke three rules, if you like. I think you know, it's clear, but if a major miner wants to grow meaningfully, then they have to get into copper. But Newmont and Barrick are the two that are really actively looking for copper.
I agree with Adrian.
Okay.
That's it?
Yeah.
It's a pretty
You know,
comprehensive
you said it
answer.
all.
All right. Another one on a particular stock. Does Arizona Gold and Silver still have high probability of getting a deposit that will be mined this cycle?
I'll pass on that.
Yeah, I don't know the stock, so.
Okay. All right. Sorry, JJ. We don't have that answer for you. Amin asks, as a Fav5 subscriber, should I add to my position at current prices?
Sure, gold is going higher.
I was just going to say that. I mean, that's what I heard. There were no signs of a top. Gold's going higher. You've got a legend picking those stocks. Why wouldn't you? Anything you want to add to that, Adrian?
No, I agree completely. I would say I do think it's a good idea for investors to have a little bit of cash in reserve, you know, in case we get a pullback. And it may not be a pullback in the whole market. It may be a pullback in a particular stock. That can happen. I mean, I don't want to mention the Fab 5 companies, but I mentioned Orla. You know, Orla was a company that I was looking at. I had a really great meeting with them in Beaver Creek. I thought, boy, I really like this company. I like the management. I like the mines. I like the growth prospects. But the stock's just too freaking expensive. And then about a week later, Newmont decided to sell their shares in the company in an overnight deal. And as always happens with these overnight deals, they sell them at a discount to get people to buy. And as always happens, what did the stock price do the next morning? Well, the stock price fell to the price of that Newmont was selling their shares. And in fact, again, as always happens, or 99% of the time happens, the stock price in the market fell below the price that Newmont sold their shares. And so that was an opportunity to jump in and buy. So I always think it's a good idea to have some cash in reserve to take advantage of those kind of opportunities.
Yeah. Good advice. Another question about Belo Sun. We've already dealt with that. Fred asks, does Pillar Gold, as it is repurposing a mine in Brazil, have that jolt factor right now as they are raising money and are now getting back into production?
I'm not familiar with the stock.
Okay, Adrian, anything?
No, I have no.
Okay. All right, moving on. Any opinions on how the change of top management at Barrick and Newmont might affect the industry dynamics?
That's a good question.
Yeah, that's for Adrian.
Is it? Well, I'm not, cut me short because I could go on for a long time. I'm not sure that, I'm not sure, and that's English understatement for I don't think, but I'm not sure there's any industry lessons to take from that. These were two disparate events, totally unrelated, just absolute coincidence that they were both announced on the same day. But nothing, you know, no general theme connecting the two of them. So I don't think you can draw any industry lessons or suggestions from that, as you could in 2012-13, when companies started replacing their CEOs for bad decisions, bad acquisitions. So in the case of Newmont, it was a planned change at the top. Tom Palmer, you know, was retiring. And they scheduled it, you know, they said he would retire at the end of the year. The lady that took over had been groomed to take, that's a bad word to use with a lady, isn't it? Sorry, help me out. What's another word? I can't think of one. But anyway, she had been groomed to take over the top job. You know, she had been to the Denver Gold Show, the big forum there, and to many other conferences, a meeting with analysts. So, you know, it was a planned transition, and so on. So with Barrick, of course, it was not a planned transition at all. It was a very, very sudden announcement. And clearly, just if you look at those two press releases, Newmont and Barrick, you can see the difference. On the one hand, you know, They gave you a reason why Tom Palmer was stepping down. They gave you a time when he was going to move, and they named the successor. With Barrick, he was gone immediately. Bristow was stepping down immediately. And although they thanked him for everything that he had done, which was a sensible thing to do, they didn't give any reason why he was leaving. That's a pretty big sign right there. And they didn't have a replacement. They only have a temporary replacement. So I think it's clear to me. It's clear what happened with Barrick was a lot of major institutional investors over the last year or so had been very dissatisfied with Barrick, both for political risk, getting into Pakistan, the mess up in Mali, and also, most importantly of all, missing a lot of opportunities for Canada. Bristow kept saying he's not paying a premium. Kinross is crazy to buy Great Bear without a feasibility study or even a resource estimate. And so-and-so's crazy to buy this one at such and such a price. And these people don't know what they're doing. And we're never going to pay a big premium like that. And I think there was a lot of frustration among big institutional shareholders. And of course, up until this year, the price of Barrick was lagging tremendously. So I think the board was just getting a lot of pressure from the institutional investors, and the process didn't start last week. The process started earlier in the year, and it's sort of ironic that in the meantime, the stock price has caught up with the others. Newmont, Barrick, the GDX, they have basically equal stock performance for the last 3 and 5 years. Which is ironic that people were complaining about Barrick's stock price. But, and of course, they announced that 4 Mile in Nevada, which last month, Bristow announced the growth in 4 Mile in Nevada, which is a great mine.
Well, I think it's a failure of Bristow that there was nobody to bring in to take over his spot.
It's a what? Sorry?
There was a failure of Bristow's to not have anybody groomed for his spot.
Well, I was going to say
there's always
that,
one guy that made all the top decisions.
Yeah.
Suggests he was getting pushed out, and therefore he didn't see it coming.
No, that's no. I mean, John, you raise a really good point, and I had this in my newsletter. I mean, there's no gainsaying that Bristow. I mean, there's no gainsaying that Bristow was right on top of that business. He knew every detail at every nook and cranny of that business. You could ask him anything and he knew the answer. He didn't have to turn to somebody and say, is that right? Or can you get me the answer? He knew it. And now, mind you, nobody would ever contradict him. So we don't know if they were correct answers. No, I'm being facetious. So, I mean, it was incredibly impressive, but he ran it, and I've said this to him to his face. He ran it as though it was a one-man show. And I've been at meetings, and if I may, I've been at meetings, analyst meetings, where there were like six of us analysts and 6 of the Barrick people sitting around for 2 hours. And Bristow was the only one that talked the entire time, even to the point, I mean, we would be giggling about it. And one of the analysts would turn and say, hey, Doug, this is a question for Doug. So Doug, what do you think about blah, 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 blah? Doug, can you give me your answer? And Bristow would pipe up and say, well, before Doug talks, let me tell you what I think. So that was a big failing, no question about that. And it's going to be interesting to see how that plays out, because that has to be part of the culture at the company, right? The culture of the company has to be, Bristow makes the decisions. Anyway, enough on that, but.
All right, the next it's not really a question, just kind of a comment. Anonymous person said a friend of mine was beaten close to death by someone who knew he had gold stored in the basement. It's not wise to let people know that you have gold. I agree. I can't argue that point at all. So thanks for sharing. The bottom line is I'm a big advocate of the first bit at least of whatever you buy in bullion for emergency, you ought to have close at hand for that emergency. So it's very liquid, very accessible. But the best protection by far is just to keep your mouth shut.
Yeah.
The people that matter in your life know what you got, and nobody else needs to know. You don't go showing it off for sure. So good point. Nicholas says, if you hold all gold and never sell, what do you do when you want income or money out? And I think this might have been directed to my comment about the 10% of net worth for, that emergency fund or that wealth insurance that I say I never sell unless I have a crisis. That's what it's there for me. It's like my health insurance, my auto insurance, my, home insurance, et cetera. You want to have it there in place. And if you have a crisis, it's there to meet the need. I don't touch it for any other reason. But I do hold precious metals for profit as well, and I do treat them very differently. I do buy and sell them. If I take a 10% position and it doubles, I sell half of it. I don't even think about it. I don't blink an eye. There's no emotion. If it falls by half, I buy half again to bring it up to my allocation. And if I do that in a bull market, I'm buying well and selling, taking profits along the way. So that's how I raise income. If that's what you meant by that, if you guys see something else in there, feel free to chime in. No?
No, I think that's good.
Okay. So Ruby comes in, says the RSI indicators have entered overbought territory, which often preceded a cooling off period. Will this happen in November, December of this year? Do you think?
Well, I've said many times in the last month that I think gold is incredibly overbought, but underowned. It's overbought but underowned. And so that's an unusual circumstance because normally when something's overbought, it's also overowned. Gold is not overowned at all, as we were talking about at the beginning of this webinar. So my sense would be, I just don't think we're going to get any kind of meaningful correction, frankly, for so long as the current fundamental circumstances remain. But we could see a phase where gold kind of eases for a while, just as we saw from April to July, end of July, where it was kind of flat for a while, a consolidation. But I think if gold consolidates, it will consolidate in a flat line rather than consolidate at a 20% lower price. That's just my guess, of course. John?
Well, I think there's always people looking to buy gold if it's lower, so that sort of supports the price. And I don't until I see something changing in the fiscal or monetary policy, I don't see any reason to take the foot off the accelerator and just stay with gold.
Yeah, I tend to agree. I think it's the biggest no-brainer on earth until you find me a consensus of congressmen and senators that are willing to, not overspend. Gold's going higher in the long term. There's no two ways about it. So, all right. Any thought on? Go ahead, Adrian.
No, go on. I was going to say at some point we'd like John to tell us how to get his newsletter and so on.
Yeah. Do you want to do that now and then continue with the questions throughout?
Sure, you can Google my name, John Doody, or John Doody's Fave 5 Golds, and you'll come up with the information. Somewhere there's supposed to be, we're doing a $500 off deal. It's really regularly $2,500, and we're giving $500 off for subscriptions. I don't know. I thought there was going to be some kind of a link to.
Yeah. So let me touch on that. That's a good point, John. Thank you. So first off, Adrian's right arm, Karen, has done a great job right at the very start. If you guys all go to the Q&A, you'll see links for Asset Strategies, for Adrian Day, for John Doody's Fab Five. So right there, you have the ability to go visit. What John's talking about is a special offer for anybody who has registered and attended or just registered for this webinar. We will send out tomorrow morning, Thursday morning early, we will send out an email to everyone who registered, not just those who attended, but everyone who registered. And in there will be the link that John's talking about to sign up for this special deal. So if you want to take advantage of it, and I encourage you to do so, it will be in the email that we send out tomorrow morning.
Okay, super.
Okay, as well as way to contact Adrian and a way to contact us as well. But the offer is going to be in there. Okay, and thank you, Karen, by the way, for doing that.
Yeah, thank you, Karen.
All right. So JJ was asking any thought on Independence Gold with no MRE estimate yet.
No.
Nope, pass. All right.
Don't know.
Okay. And that's okay. I think this is one that everybody knows about. Seabridge Gold. Art was asking what seems to be the problem? No production.
Well, the problem is getting the right deal. Seabridge is effectively controlled by Friedberg, Albert Friedberg, who runs a hedge fund and also a family office of money management and whatever. And 25 to 30% of Seabridge is controlled by this insider group. Seabridge or Friedberg is an enormous gold bull, as much as any of us, and he's not going to sell cheap. If this was a normal exploration stock where the insiders owed 5 or 6% or something like that, it would have been long gone, because outside takeover could have come along and overcome the block that the insiders own. But with 25 to 30% of it controlled by this one insider group, you can't force a hostile takeover on it. You can't get enough other people to go along with the takeover price. So right now, the company is negotiating with 3 finalists for a joint venture deal to take over the KSM deposit, which is the largest undeveloped deposit in the world. KSM has a feasibility that will show it produces 1.4 million ounces a year and 250 million pounds of copper a year. It's an enormous project. It needs $6 billion to build it, and there are 3 major finalist bidders to put the money up to build it, and I have guesses on them, but I don't know who they are, but I could guess. And Rudy Frank, the chairman, has said that by the end of the year they expect to have a joint venture announced. The stock has doubled in the last 6 months from around 12 to around 25, and my target is multiples higher than that. But they need to put together this financing group that, or really a takeover. I mean, there's only really 4 or 5 companies in the world could handle this, and a couple are gold companies and a couple of copper companies, and we'll have to see what comes out of this. But anyway, the Seabridge is something to hold. Seabridge is something to hold now and expect it to go higher.
So, John, can I ask you? I'll let people know the symbol. It's SA on New York, just in case. Are you thinking that this will be 100% takeover and Seabridge will be gone, or do you think Seabridge is going to retain an interest?
We don't know really. It depends who the final bidders are. If there's a copper companies are comfortable with joint ventures, and they typically earn to earn their interest by funding the capex. If it's a gold company, they're going to want the whole thing, and the gold company would give shares, in my opinion, and so that and the advantage of shares would be it doesn't cost a gold company anything to buy Seabridge. I mean, it costs dilution, but no out-of-pocket money, and gold companies typically buy with shares. They use their money for building projects, not to buying them. And the advantage of shares to a owner is that you would get an immediate dividend, because whoever is putting the money up or putting the shares up to take over Seabridge would be a dividend paying stock. So you'd have income stream immediately. Whereas from the one of the big miners taking it over, you'd have to wait 5 years to get a payout to start because you'd be getting a portion of the joint venture interest.
Right.
Mhm.
Okay.
And we've got a few more questions. We've got another 5 minutes maybe for questions, so we might kind of move into a little lightning round here, see if we can get through them. If not, we'll go as far as we can. And then I'm going to want to stop and just have everybody just give their parting thoughts. You know, what's the last thing you want to kind of leave with folks here tonight? So first one is, does John have any new thoughts on Crystalex, Golden Minerals, or Rubicon Minerals?
None.
None? Okay, so this is going to go fast. Any opinion on a Cisco development? Either.
Oh, Cisco, you mean?
Oh, Cisco development, yeah.
Yeah. Adrian follows that, I'm sure.
Well, it's interesting you say that. Well, sorry, lightning round. I prefer when I own a royalty company that has a large royalty on a development project, I tend not to own a development project as well. And so a Cisco, or now it's called OR Royalties, stupid name, but anyway, they're proud of it. So OR Royalties, which used to be a Cisco Royalties, has a large royalty on a Cisco Developments project. So I don't own a Cisco development as well.
Okay. All right. Brett asks, Agnico is up 116% year to date, have a fair amount of their stock. The pace seems unstoppable, but do you believe they can continue on this trajectory, or is it time to take some profits off the table?
Well, I'll go if you like. You know, there's nothing ever wrong about taking money off the table, particularly your initial investment. But I think it's going higher still because it's a quality mining stock, and it's got a diversified. I think they have 15 or 19 mines. It's well diversified and but basically no political risk. So they mine where you'd want to be mining if you want to avoid political risk. So I'm not selling any, but you know, you got to look at your own portfolio situation.
No, I agree, only I would put more of an emphasis on the I'm not selling any. You know, Agnico is the gold standard of miners, in my view. And if you think the gold bull market is going to last another 1, 2, 3, 4, 5 years, and you think gold is going to go to 5,000 or 6,000, you want to own Agnico. It's as simple as that. You want to own it. It's not expensive. That's the other point. Even at today's price, it is not overvalued. It's not richly valued.
Yeah, and I'm not even the stock analyst guy on this panel, but from everything I heard tonight, it is the cream of the crop, the gold standard, and there's no top in sight. I'm thinking you hold on, maybe add more. So Irv was asking thoughts on utilizing options on your key stocks.
I use options quite a lot, but I use options to buy things. In other words, I sell puts on things that I want to own. But of course, in this market, the bigger risk is that you lose out. But the thing about selling puts on something is that, in my view, you win either way. You either have the stock, but you want to own put to you at a lower price than it's trading at, or you pocket the income. So either way, you win. So I do that quite a lot. Selling calls, sorry, go on.
Well, I was going to say, as I view it, the stocks are options on the gold price. So I don't own any puts or calls or anything. I just own the stocks.
Yeah.
Either one of you familiar with Hemlo Mines?
Yeah.
Okay, so do you think the new owners can make upgrades and changes to increase production from 145,000 ounces of gold to 200,000 ounces of gold?
John, do you?
What's the stock?
Hemlo
Hemlo.
Mines?
Hemlo.
I don't know the stock.
Okay.
No, but you know Hemlo, the mine.
Oh, Anglo?
No,
Oh,
Hemlo. Hemlo. Hemlo.
Hemlo. Oh, yeah. Well, that's a great opportunity. I was hoping that one of the Fave Five would buy it. But But I don't know. I'm not an engineer. I don't know. I suppose they could, but I don't really know.
Yeah, I mean, I don't know about 200,000 or anything specific, but what I do know is that there are some very, very strong people back in that company. So, yeah, I think they have a good odds of doing it. But that's an old mine. Let's not forget that mine's been around a long time.
Yeah,
So,
and old mines are never depleted. They're depleted at a certain price. But old mine, we have three in the Fave 5 that have old mines that are coming back into production because they stopped production when the gold price was lower, and but they stopped in ore. They stopped just because of the cost wasn't enough, and now they can produce and make a profit at that new higher price, and so the mines are coming back.
Homestake, of course, is a classic example, the old Homestake mine.
Yeah.
Where they stopped just because of a price, not because they ran out of ore. No, I think they've got a good chance of doing it. A good chance of doing it.
All right. One more question, then a few companies that we're really going to go lightning round on because we're already past 8:25. But what other large mining companies have issues with succession planning? Is this something most investors think about? I'm thinking, Adrian, from your comments earlier that, management is the most important. I'm thinking every investor ought to be thinking about this, but
I think most of the large companies, do think about succession and do have plans. At the same time, the truth is that for a lot of these companies, one man has really, is really largely responsible for building the company. I mean, you look at Wheaton River, for example. I mean, Randy Smallwood is the face of that company. But if, God forbid, something were to happen to Randy, there are other people at the company, and there are other people that are known to the analyst community. There are other people that make decisions at the company. It's not a one-man show. But a lot of the companies have sort of one man as the face of a company, I think.
Yeah, I agree.
Okay. All right. There's a couple last minute questions on individual stocks. I don't think we can get there. I rather at this point, and thank you all for your questions. I think we got to most of them. We did a great job, I think. I'd like to go around and start with you, John. Most important as our guest. If you had one thing you wanted to leave everybody with tonight that they just gotta know this, what would that be?
Information flow. If you're going to buy anything, you got to get continuing information. You can't just buy it and forget it. These are not buy and forget stocks. The bullion may be buy and forget, but the stocks themselves, there's risks, and Mother Nature often disappoints, and there's management issues, and you have to have a flow of information on whatever stock you buy.
All right. Thank you. Adrian?
Yeah, I agree with what John said 100%. I'll just add something that's not contradictory, and that is that, I think gold is going meaningfully higher, and so over a number of years. And so the risk is for a lot of people that you get shaken out too soon. There will be a correction at some point. As we've said tonight, we don't know when that's coming. But you only have to think back to 1974, 75, when gold dropped 100%. You only have to think of 2006, when gold dropped, what was it, about 30% in a matter of a couple of months. And the gold stock's a lot more than that. So the danger, I think, for people after such a big run is to get out too early. I think gold is going much higher.
I tend to agree. And anybody that is listening tonight, if you want to get a feel for those 10 or so indicators that I mentioned that I'm looking forward to see at the top, I'm happy to share them with you. You've got our web address. Just send us a question to infoasi@assetstrategies.com. The one thing I want to leave you with is I think John and Adrian know there was a recent news piece that came out over the last week. Morgan Stanley came out and they changed their allocation, right? So they said, from now on, instead of going 60-40 stocks to bonds, we want to go 60% in stocks, 20% in bonds. So they cut their bond allocation in half, and it all went to gold. They're going 20% in gold. This is significant. It's not quite gold on the cover of Money Magazine. I think that's the kiss of death, right? When you make Money Magazine, it's over. I don't even know if Money Magazine still exists. But anyway, this is significant. This is a blue chip broker. We're talking 4.8 trillion assets under management. If they go 20% from bonds to gold, you're looking at $960 billion worth of gold. That's at $4,000 an ounce. That's 240 million ounces. And that comes out to roughly with 32,151 ounces in a kilo, or a metric ton, I'm sorry. That means you're going to own 7,465 metric tons. The US, the largest central bank holding of gold in the world, has 8,133.5. And that's one brokerage. All right. Now, I don't think they're going to do that. But this is starting to look a little bit more mainstream, a little less fringe, and again, no top in sight. If you're worried that you missed out, I'm telling you, you're dead wrong. Find a way to get in this market. That's all I can say. You're missing out. So get in, but it's not over. So, any other thoughts other than who our next guest is?
No,
I don't remember the date off the top of my head, Adrian, but it will come out. We'll announce it in the email tomorrow, unless Adrian has it. But we are going to welcome Brian London of Jefferson Financial and the man behind the New Orleans Investment Conference. Both Adrian and I will be down there in New Orleans in about a few weeks, and we'll get Brian shortly after the conference to assess the market and assess the conference and where things are. Do you have the date?
Yep, Wednesday the 19th.
Wednesday the 19th, 7 p.m. Eastern.
Of November.
I'm sorry, November 19th.
Yeah, yeah.
Wednesday, November 19th, 7 p.m. Eastern. Brian and London will join us. And I thank you all for being with us tonight. John, thank you so much. It was wonderful to spend some time and pull some of that knowledge out of that fantastic brain you got.
Thank you, Rich. It's been a great learning experience for me, too.
Thank you, John.
And as always, Adrian, thank you. And thank you all. And we'll see you next time. Have a great
Thank everyone. Okay, thank you. Rich?
Yes.
Have you stopped recording?
I am ending the webinar for all.